We're getting a little echo from your computer. But Tom was kind enough to drive up from the Boston area. We've got David McFarlane on the call as well, who's a colleague of Tom's. And I'm going to let them introduce themselves, but needless to say, we're very excited that these two have been able to jump into the lurch here and help us out, where we had a bit of a late change with York IE, and we're happy to have you, Tom, and looking forward for the day. Thanks.
Thanks, Joe. Nice to meet you all. I'm Tom Lizay. I'm one of the co-founders of Companyon Ventures in Boston. And before we get into some of the materials we prepared, I just want to say, beware of all the advice you hear from VCs, because you'll see on Twitter and on Medium advice that probably directly contradicts like everything we're going to say. So try to apply some of this general perspective to your own business. And I always like to say that up front. David, my colleague here, he's the real SaaS operator. He's our operating partner at Companyon. He has been COO at, I don't know, 5, 6, 7 SaaS companies and taken some of them €0 to $1 billion, and really has lived this world. So he's going to drive most of our presentation. But what we really hope to do is leave some time for some discussion and Q&A, so you guys can all get out of it what you came here for. So we'll try to be brief. David, if you can go full screen.
Okay.
We have our IT setup working here. So perfect. So as I talked about before, it's important to know like what our perspective is on SaaS. So at Companyon, we invest in B2B software companies, not all SaaS, by the way. Most of our companies are between 1 and 3 million of ARR, right? So they've had a few years of product market fit. There's a little more data, and we're a little more, I would say, data intensive with some of the topics we're going to present here. And we'll try to help sort of extrapolate some of those themes down to an earlier stage company where you may not have some of the data to actually know exactly what your gross margins are or your CAC to LTV is, and those sort of things. David, if you could go to the next one. And so as far as our stage, if you think about the startup journey from your first friends and family and angel rounds all the way through, Series A, B, C, and PE, we're right sort of between seed and Series A, which is an interesting stage, and those labels kind of mean a lot of different things to different people. If you could go forward one more, David. But the crux of what we do at Companyon, it's really that transition from a founder-led go-to-market operation where there's a lot of instinct, a lot of sort of hand-to-hand combat, and try to introduce some tools, some methodologies, some mathematics and some data, as well as help building a team to get that predictable, repeatable go-to-market, which is what a SaaS business is all about. And as far as how we support our companies, which kind of plays into some of our topics here, we actually have, similar to York, have teams of people who go in and work for our CEOs. Most important one is usually talent management and hiring, especially hiring those first senior roles and getting that right. Most of our companies are trying to figure out how to build a repeatable and sort of structured demand gen engine to get those leads in. And then, of course, right behind that is just sales execution. I think most of our founders are feeling insecure about whether or not they're selling well. And that means different things at different stages. And then lastly, we were very, very heavily involved in instrumenting our companies to get the data that we're going to need to actually understand some of the key metrics in SaaS that feed the dashboards that we build. So that's a little bit about us and kind of gives you perspective on where we're coming from. Just a quick case study on our, just kind of our typical playbook as an investor. If we come in around $1 million of ARR, we do things like segmentation and messaging and positioning, a lot of that fundamental go-to-market stuff, even before there's even any emphasis on demand gen or improving selling. We instrument the business to get KPIs. In this particular company, my colleague David jumped in as fractional COO for about 6 months. And we had to like drag him out of that company. He was having so much fun to get him back. Then that company had the instrumentation. They could demonstrate to Series A, B, Cs that $1 in is $2 out, and they could tell exactly how long that would take and how many sales resources they would need and how much marketing investment they would need to need. So they got that investment, then started building out the executive team with some of our help, and now they're past 5 million of ARR and on to Series B and beyond. And so again, that was a transition from the founder who was leading all of the sales and the marketing and product and raising money. You guys probably have lived this as have I as an entrepreneur. Now he's got, about 2 years later, a full team, and it's like a nicely humming machine. And that's what we aim to help our companies do. One of the topics that we were asked to present is like, what do VCs look for? And I hate that question because what we look for is so different than the VC down the street. And whether it's pre-seed, seed, or Series A, the answers are always really different. But we try to just give you guys like some high level themes about what I think might be generally applicable. So if you think about pre-seed and seed, you might have a group of pilot customers. It's great if those customers are renewing, like if you've had them for more than a year. But what fundamentally pre-seed and seed investors are looking for is certainly they're banking on the team, right? And the market. But anything you can do to sort of demonstrate product market fit, like that is number one, right? And it's even number one at our stage. Because go-to-market execution is kind of meaningless if you don't have that product market fit and customers don't love your product and they're not buying more. So typically, and this is like, we're a Boston-based fund, by the way, but we source everywhere. So we have data from all across the country and even other countries as well. But
Can I
typically,
just ask a question?
yeah,
I forgot to mention that. Feel free to jump in with questions at any time during the call today. And people that are online, all you need to do is raise your hand or electronically raise your hand on Zoom, and I'll be watching the screen. And we'll ask you to pipe in and take yourself off of mute. Question though, that I had, Tom, was how do you, an early stage company that's just getting started with very, very few clients. I mean, how do you define product market fit at that level?
you can't define product market fit, but if you have a referenceable customer, that, I mean, this is in the context of fundraising. If they'll talk to an investor and just say, hey, here was our problem. This is what this software is doing for us. And in many cases, they haven't deployed at this stage company-wide. Your customer might just start with a limited pilot. But if they're planning to roll it out wider, broader, deeper, get more users on, that's at that stage, that's like a really good hint. And then the question becomes from the investor's perspective, is that a one-off kind of unique customer, or is that kind of a pattern in the industry? And then so that's what the investors start to peel back at. What's customer number 2, 3, 4, 5 look like? And when you're certainly less than 100K or less than 500K of ARR, like there may not be that much evidence, but all you can do is just try to get more of that customer evidence, because that speaks volumes more than anything you can put in a slide. It is the usage of your product and the growth. One thing on that, it's like if your customer is your cousin, we know
that gets discounted.
yeah, it gets a little discounted. And I only make that reference because I have seen that. And even if you're a founder and you're the only one doing the selling, it should be relatively easy to have a high growth rate with very small ARR. Going from 5 to 10, 10 to 50 is a lot harder than going from 10 million to 50 million. And so what these pre-seed and seed investors, they are going to look for some velocity on your initial revenue ramp. The other thing that ties into that theme is if you're telling a story that your average price is 50K annual, for example, on your subscription, and all your pilot customers are 5K annual, it's not that credible. Like you'd have to explain why is it an expansion to 50? What's the disconnect between your early pilot customer pricing and what you think at scale it will be? So some startups essentially basically give away their product to get customers. If you track usage of your product inside of that customer, usually those are not heavily used customers, right? They're kicking the tires.
Jordan, do you want to take yourself off mute and come in?
Yeah, thanks. So one of the questions I have looking at this is if you could talk about ARPA, or for some of these numbers, I was working at a SaaS company where the average revenue per account is, 150K versus say, you're looking on the lower end of the spectrum, targeting small business at, say 200. So is there sort of general trends you're looking for with the average number of accounts or customers at different pre-seed stages that you're looking at?
Yeah, I think if we can hold on that question, David's actually going to get into that topic in more detail. So I think we'll hit most of what you're asking, if that's okay.
Yeah, sure. Thanks.
Okay, great. Another little interesting metric that might be helpful in positioning your company at the pre-seed and seed stage is how long it took you to go from zero, so product launch, and you can eliminate R&D time, to whatever your ARR is today. It's 50K, 100K, 500K. I've seen some really interesting pitches where I would not necessarily have known that these companies had great early velocity, but when they called it out in a slide, 9 months from 0 to 100K, it's a little more powerful than saying our ARR is at 100K. So just something to think about, and maybe highlight if you're proud of that. And like all VCs, and this is VC, and that's why I don't have investors in the title of the slide. It's specifically VC. They want to know, can it at least get to 100 million of ARR, if not more? Team, market, all that stuff. I will say there are plenty of other sources of funding. So angels don't necessarily have that outlook. Strategic investors like corporate VCs don't always invest based on pure sort of financial return thesis. And then there are some thematic funds. State of Maine here is probably, I'm guessing one of their criteria is not that every company is going to be a unicorn. They have a mission-driven investment thesis. So this is sort of, I'm characterizing your average sort of seed VC fund out there. Once you're coming out of seed, or I'll pause there. Do we have any questions just from these bullets here? Okay. Online? Okay. So at pre-seed and seed, you're selling a vision and you're showing some early data, right? That's the whole story. When you're at sort of 1 million of ARR, I think when this story changes a little bit, people are looking more at evidence. You can't weave a big vision and a big story and wave your hands if you've raised $5 million and you don't have a lot of traction, and you certainly don't have a lot of data, historical data about your growth and trends. So that's much harder. So it's like, I wouldn't even talk to those VCs until you feel like you have some more detailed go-to-market metrics in place. So early on, you may not know what your net revenue retention is because you may not have renewals yet. So pre-seed, not going to look at that. Post-seed and Series A, that's a huge metric, and we'll get into why that's so important. But that revenue retention metric, if it's below 100%, meaning you're churning more than you're upselling, a lot of investors are going to have heartburn, but it's also a warning sign to you that there's something wrong. In theory, with a SaaS business, you could fire your sales force at any time and your business keeps growing, right? If you turn off the sales spigot and then you decay to zero, that's not good. So bit of an exaggeration, but you get the point. So these are just some basic SaaS metrics you'll read in the blogs. we won't go into all of them right now because we're gonna cover them in David's talk. But I mean, I just goes to show that it becomes less vision and more data as you get later and later stage, more data and evidence. David, why don't you take over from here? Because we're getting into the more fun part.
Yeah, it looked like a question. First of all, can you hear me okay? Okay, so it looked like a question came up on COGS actually in the list here from Jay. What do you include in COGS for a SaaS as related to your 75% margin? This is actually a huge area of focus for us when we're working with companies, and we do go through a lot of different effort to help them through how they allocate their COGS more effectively and how they reduce those COGS. But the sort of like a rule of thumb is, if you were to take away that particular cost element, would your service continue to run? If the cost element is required for your service to run day to day, then it's part of your COGS. That's typically the rule of thumb. So that's sort of a guiding principle that we use with folks. But understanding COGS and driving up gross margin is really, really huge. I'm just going to kind of, whilst we're on this slide, just a couple of other things that I think are going to be important that come back out as we get further into the discussion. Net recurring revenue. I just asked the room. I can't really see the room from where I am, but I'll ask the room. Like, is that a metric that people are familiar with? Like, put your hand up if you're familiar with that, if that's a common metric. Okay. All right. So about half, right? So it's one of the most important metrics in terms of building a sustainable SaaS business, and it's basically, if you looked at a cohort of business in, say, January of the prior year, we'd look again at that cohort in the following January. We look at how much revenue they were creating in the first January versus how much revenue they're creating in the second January, and that basically second over first is what gives us the percentage for NRR. And for many VCs, if you're not at or in the vicinity or on the pathway to getting to at least 105% NRR, then you're not going to be very interesting, because that is the engine that really supports your overall growth. So let me move on to the next slide, and we can get into a lot of this in more detail. And so what I've done here is I put up a couple of
one interjection on gross margin, because I think we always get this question. What if I have a resource, part-time, part of one person who's responsible for onboarding a customer? So maybe it's a customer support person who's also doing other things. Maybe they're selling. In small companies, we have multiple roles. Usually we'll say, take a percentage of that person's compensation, the percentage that they're doing for onboarding and true support, and put that in COGS. And you can split the other part of that person's salary if they're selling or doing some admin work or whatever, and put that out of COGS. Bigger companies will just have dedicated, customer support teams and onboarding teams that are, so the whole team goes into COGS. But we're often like splitting costs of individual people at the early stage.
I have a question. A lot of our companies, especially when they start up, they don't get their pricing right, or they don't get the product features right at startup. And so their first couple of years, they may have a churn rate as those early adopters realize that it wasn't the right fit. But their cohort that is coming on now at a higher price, usually or hopefully has a higher or lower churn rate, a higher net recurring revenue. Does a VC look at that when you begin to do an evaluation on the company as to some of those early customers, they weren't worth anything anyway, and it's okay if they drop off?
From the VC perspective, before David gets into this on the operating side, yes, sometimes as VCs, we have to do our own segmentation and do all the work to realize, oh, customers in this market perform really poorly versus customers who are in that market, or bigger customers, medium, small. What we have our companies do, we just had a company close their Series B round, and their average NRR was like, I think below 100%. But through a segmentation exercise, Their enterprise cohort was like at 125%. Middle market was like at 105%, and all these legacy SMBs that they started with years ago were like at 80%. So they did the work for the VC and saying, we're focused on these two segments because that's what's driving our retention and our growth, and we're going to stop selling to these legacy sort of customers we took on as a really early company. Now, to do the segmentation, you have to actually capture some attributes about each one of your customers, and David will talk a little bit about some recommendations there. But yeah, that's huge. And in the beginning, you should be trying to take everyone, because you don't know what your ideal customer profile will be necessarily. And just figure it out through data. Over to you, Glenn.
I'm going to sort of reiterate some of that and just go a little bit back over my introduction, because it's very relevant to all the things we're going to talk about. I'm an operator. I'm not a venture capitalist per se. As Tom said, I've done this about 8 times now, actually, with different companies, taking them all the way through, some of them through public offerings, most of them through M&A exits or growth equity or private equity, and at least 2 that went nowhere. So kind of understand that full spectrum. And you pick up a lot of insights. We're going to share a bunch of those today, but I will also say this. I would typically go into an organization as the president and the COO alongside a founder and CEO. And so my job was to help the organization put together this strategy and then execute upon it. And, you know, qualitatively, half of my effort would be all the best practices and things that we're going to talk about and how you bring those to bear. But the other half was actually how you help the founding team go through this transition from being a founder-led business to being a professionally led go-to-market machine. And there's a lot of things that you as individuals have to go through. So the saying that you always hear or often hear of like, what got you here won't necessarily get you there is really, really important. When you're in a seed stage process and you're bootstrapping your company, you're trying to grab just about everything and anything, every dollar that will actually help contribute to the bottom line and fund the business, and everything that will help you bulk up and look as big and as attractive as possible. But as you get beyond that stage into Series A, it's really about demonstrating that you can identify specific market segments that offer the most profitable value creation opportunity. And it's a whole different set of disciplines that also includes the most difficult one, which is saying no and not doing business where you may have done business before. So when you get to understand these market segments, one of the things you have to be able to do is to discipline yourself to focus your execution. We call it good revenue, on good revenue that's coming from the right segments. But maybe we can get into a few slides that will let us discuss a lot of that in more detail. So this little animated slide, many of you may have seen in different blog posts. I think it was point 9, Christoph Jans, who actually did this originally, but it helps you kind of think a little bit about what sort of sales model you should be considering, and goes to the question that came up earlier on: what's the difference between if I'm doing $100,000 transaction versus a $100 transaction? So if you think about the different sort of price points at which you may be selling your product, and obviously this is all rounded and simplified to make it easy to discuss, but you might have an annual contract value that's only $100 that you're talking about a really, really sort of high volume business. $1,000 is the rabbit, 10,000 is the deer, 100,000 is the elephant, $1 million per transaction is the whale. But what we ask you to think about is, as we indicated earlier on, we want to get to $100 million. So what have I got to do transaction wise? Well, it's obviously the world's simplest math. I got to do 1 million transactions if they're $100 per. So what kind of go-to-market channels and infrastructure do I need in order to be able to deliver that kind of revenue at scale with the right customer acquisition costs that will lead to a profitable and valuable business? And that's a big part of what you have to do when you're thinking about your business. And quite often we can get a little confused because in those early stages, it's founder-led and we can throw a whole bunch of resource and people at closing a deal. But what happens when you've got to deliver 100,000 of them? And the rabbit is one of the areas where a lot of companies in the startup have problems, where they have an ACV around about $1,000. That actually proves to be a very difficult area to sustain, because it's kind of expensive enough that self-service alone typically isn't enough, and you have to start putting human capital, customer success folks, salespeople, advocates into the process, and that pushes up your customer acquisition cost. And so we typically find those who start off in the 1,000 area, looking at all their pricing, packaging, and feature function capabilities, trying to drive up to that $10,000 per transaction or above. Let me stop there for a moment because somebody did ask a question about this particular area. I just want to see if we're getting close to what you wanted to discuss. If whoever was there could pipe up, that would be great. Who asked the question?
It was
Yeah,
Jordan.
this is awesome. Thanks so much, David.
Okay, all right, cool. So this is a big part of what you have to think about. What is the sales motion that I'm building in order to deliver $100 million?
With a hand, David.
Okay.
Are you sharing these slides?
Yeah, oh yeah, the slides will go out, I guess, at some point today. Joe will send them out. Put the pens
Yeah.
down.
Yeah, sorry, I should have told you that. And actually within it are a lot of links. So as we go through these slides, I'll point many of them out, but you're going to be able to link out to a lot of tools and a lot of examples that will support this conversation. But okay, well, that was an easy one to answer. Let's move on. So we talked a little bit about market segmentation and getting to that good revenue. So if you look on the left-hand side here, we typically go into an organization and we help them to start thinking about what kind of business is the most profitable business that they want to focus on. And so we'll look at many different attributes that here we're talking about two of the most formative ones, which is we want to understand what your close rate is around a certain market segment. How quickly and how readily does that segment convert to business? And then we also want to look at the retention rate, the lifetime value, the combination of actually of the ACV and the retention rate and any expansion that you can drive within that market segment, within that customer, within that market segment. And you'll have a group of folks that are in the top left-hand corner that are super attractive because we can close them real fast. And we'll have a bunch of folks that are super attractive because they yield a long-term value. And quite often there's a link to that. Quite often the bottom right is more enterprise oriented and the top left might be maybe mid-market or even SMB for different organizations. What we want to do is find the best possible combination, those segments with the highest close rate and the highest retention LTV combination. And so to do that, we've got to be super intentional about the process. And so just going down on the right-hand side, some of the things that we look to do with the companies right up front to help them, put them in a position to do this analysis. So first of all, you've got to document your sales journey, the entire journey. So you've got to have a clear understanding of what's behind terms that I'm sure many of you know and use, like MQL, marketing qualified lead, versus an SQL, a sales qualified lead, versus a SAO, a sales accepted opportunity, versus SQO, a sales qualified opportunity, all the way through to a one contract, and then how they expand. And we go through a process with you to document them, and in particular, to focus on the exit criteria of each stage. So what have I got to do and demonstrate before I can become a sales qualified opportunity in this particular cycle? So that's the first step. The second is we want to try to attributize, i.e. create attributes that we can capture externally and apply to the leads and opportunities and customers so that we can measure them effectively. Now, the obvious attributes that most of us will gravitate to right away is going to be, well, company size, how many employees, how much revenue, maybe industry. These are all the sort of firmographic data that you can get from the Zoom info or any number of different data sources. And absolutely, yes, we want to capture that. But we also encourage you to look very closely and actually begin your segmentation process around what are the use cases that the particular customers are driving towards.
Okay. David, let's pause for a sec.
David, this is Matt. I just have a question. A lot of our startup companies struggle with that first documenting the sales stage issue because they think they know how customer buys and moves through the funnel. But they find over time that really changes. So these are companies that are, taking advantage. We've got discounts with HubSpot and we're using Salesforce or something like that. So it's like a shiny new tool. You want to get in there, you want to document, you want to begin generating the data. Do you find in the SaaS-based customers that you deal with that the sales stages are consistent? Do you see the same ones across all the companies? Or do you see a significant difference in the sales stages as they begin?
Okay, so we encourage everybody to follow a consistent set of stages that I mentioned before: MQL, SQL, SAO, SQO. However, each company is going to define those differently as to what each one of those means, and that's a big part of this documentation exercise. But by getting them to follow and understand the general purpose of saying, what is an MQL, a marketing qualified lead? It's somebody who is in the funnel, who has raised their hand and demonstrated some intent towards the value proposition specific to that segment. Remember, we want to think about use cases, different value propositions for different segments. So, so we help them use a general process of MQL, SQL, etc., but then help them actually define explicitly what is required to qualify for each of those stages. And more importantly, comes here a little bit later in this list, to instrument it in their tools. So one of the things that we're going to talk about that's really important is, for instance, capturing the date of when somebody enters a stage and when somebody leaves a stage. And to do that, you have to do some things in HubSpot. It doesn't do it very well out of the box. Salesforce does it better, but most of us tend to start our marketing attribution, our marketing automation in HubSpot. So we help you understand how to capture those attributes in your objects, and then how to use that data to do cycle time analysis between stages and cohort conversion analysis. I'm sorry, it does get a little bit more complicated than we often think of as just simply putting an Excel spreadsheet together saying how many MQLs and how many SQLs, because you actually need to understand it by cohorts. So how many MQLs did I create in January, and then how long did it take those MQLs to convert to the next stage? So I understand the cycle time, and then what was the percentage conversion of that particular cohort, so I understand how my funnel is converting through those stages. And then I take a second look at it, which is just a chronological look, which is just, okay, what's my volume of MQLs that I have at my disposal in January, and what's my volume of MQLs in February, so I can see generally how the pipeline is building. You need both of those views, and you need to learn how to instrument your HubSpot and other products to capture them.
Just a quick survey of hands. Who in this room is personally either marketing or selling for the company? So about maybe 2/3, and online. A few hands. Okay. Who has defined funnel stages along something close to what David was describing to sort of track your opportunities? Okay, most have. Okay. Are there any questions just about that marketing and sales funnel that we want to get into before we leave? Okay.
Jordan, your hands up. Do you have a question, or are you just saying you've got a sales funnel process? There you go. Thank you.
I mean, I definitely have those issues, like tweaking the dashboards within HubSpot. So if there's any actual advice you can give around like getting those dashboards together, I've spent a stupid amount of hours trying to make that work within HubSpot. So we welcome any tips there. I don't know if we're going to get that in the weeds today, but if there are any links or anything you can offer, that would be very helpful.
The comment was how it's hard to instrument HubSpot to get those dashboards for those online. If it makes you feel better, we actually build the dashboards for our companies in Excel, because it just is faster. You can just copy a month's worth of data from one field and drop it in Excel, and you're done. The automation, you can probably hold off for a while.
Yeah.
We do a lot of sales training and kind of sales execution stuff with our portfolio, and time again, when David said, what is the requirements for a customer to move from one stage to another, there actually is a pretty rigorous checklist. Like, has the buyer been identified? Have they seen a demo? Do they have a deployment timeline in place? And there's it's all that qualification that might be on an inbound opportunity. If the answer is no, keep them higher up in the funnel. And you'll be happy you did. So it slows things down at the top, but those opportunities that make it to the bottom of your funnel and are in proposal stage will have a much higher likelihood of closing and will close faster. So it's kind of counterintuitive, and we have some resources on our website that David has linked to about that sort of thing, but this whole issue of vanity metrics comes up. Like I see pitch decks with MQL growth over time as like a key metric, and David, I think, was going to point out that's kind of a meaningless metric, because how loosely or tightly you define it will drastically change the slope of that MQL growth. What's more interesting is how many customers are you engaged with in real like pricing discussions and deployment, and like that's what we call a sales qualified opportunity, which is our North Star for sort of top of funnel growth. But I mean, we're getting into the weeds on some of the
I love it.
stuff, but we could go all day on that, but back to you.
Yeah, and I'm just going to sort of reinforce that. One, I'm just going to ask Matt or someone if the people have questions that they want to follow up with at the end of this session, if we capture those, and we'll put our email address, if it's not already apparent, in with the PDF document. You can send an email to us and we'll follow up with you and we'll give you more details. So we have folks who can actually help you through that HubSpot process to create those objects and capture an instrument in the way that we're describing. We're happy to help. There's methodologies like BANT, you probably heard, and MEDPIC, and we can help you understand where and if to use those. And we'll take this opportunity to make this one comment, which is, of course, people obsess rightfully on, is there a budget? It typically less than 10% of the time is there an identified budget at this early stage of an opportunity. So be careful about that one. It's quite often a greenfield situation that you have to help create budget for. But back into this sequence. So these attributes, some of them are going to be readily available externally, but some of them you have to capture through your lead pursuit process. So you might have just a couple of questions, not too much friction, that would help you identify a specific use case, for instance, or a personalized layout on the landing page that would help you indicate whether or not somebody's coming in specifically around a targeted use case. But you have to learn how to attributize. Then you have to instrument, as we were just describing, in Salesforce or most likely in HubSpot. And then you have to start to identify, well, what is the cohort of, what is the segment that's the most attractive to us? And I'm going to show you a couple of slides around real analysis there. And to that last point, then start to have a discipline of looking at your business, not just as one overall, but starting to look through the lens of those segments so that you actually understand where the most profitable business is, and you can actually tune your go-to-market engine around that. So let's take a look at a couple of examples here. So this is not doctored up for this or anything. This is part of an analysis that we did with one of our companies, and we looked at things in two different lenses. One was we were looking at the sales cycle time and the ACV. And we plotted out these different attributes that had become apparent to us as we did our early cohort analysis. And so here we can see a high ACV and a low close rate means a relatively attractive segment that's a high velocity acquisition. So companies that for these guys had a medium security posture, we had a way of identifying low security posture versus medium versus high for this particular company, ended up being a very attractive part of that segment when they were focused on this use case, which long description they called forecasting and identifying risk. And so that combination together was clearly something that was attractive for us to understand as a specific segment. But then we also looked at the retention rates against some of those same attributes, and we could see that there was actually a different use case that really led the way there. It was a bunch of operational improvement use cases, but you still saw that forecasting and identifying risk use cases as well. So if you were looking at this, you would target different segments for different use cases. So from a customer success point of view, we want to be able to encourage this use case around ops improvement, as they called it. And so we might actually acquire somebody through forecasting and identifying risk use case, and then work hard in the customer success process to get them to expand their usage into these other use cases, because we know that was stickier and would drive greater retention as we went forward. So that's the kind of analysis that we want to do, or you want to be thinking about doing in your pipeline, to understand where to focus your go-to-market energy. Any questions?
And I think at the very early stages, you may not have enough data to do the plot. I think the point is to create the instrumentation and think about assigning attributes to customers, so that when you get 5, 10, 15, you will start to see the patterns emerge.
There's a question, I think, from Jordan on that topic. Do you want to take your mute off, Jordan, and ask that question?
Yeah, I'm just wondering at what volume is this kind of analysis something that we should be looking towards?
Well, we are typically engaging with companies that are probably at north of 20 plus transactions a year at the low end, and maybe hundreds or thousands of transactions. Obviously, if you've only got a couple of transactions, it's harder, but I would start right away. Like as early as you can, start to understand what it is about your first customers that are demonstrating the most exciting attributes in terms of how quickly they close and how well they expand over time. You can't start early enough. Okay, so the next segment of discussion was talking about, how do you think about tracking performances, in particular KPIs and KPI dashboards. So we put a few slides together that we can use to talk our way through this. So let me start here with just, TOFU top of funnel tracking. So first of all, can you see this, or do I need to zoom in to make it clearer, Tom? Do you think everyone can see that? Okay, cool. So we talked a little bit earlier on about MQL, SQO stages, and here again, we're reinforcing clear definitions of the exit criteria from each stage. The entrance criteria is important, but the exit criteria is also important. And what we would typically do in the top of funnel dashboard in this super simple is just track what we're seeing here on a monthly basis. We do actually have a deeper dive that looks at the cohort conversion rates and the cycle times, but we typically use this in the summary section. And you'll see that there's a target in blue. And over time, we help to create the ability, once we learn some of these things about conversion rates and cycle times, we can actually start to build that into the model, so that we're looking at, okay, well, if we want to realize this much revenue on a monthly basis, and I understand what the conversion rate is and the cycle time between each of the stages, we literally kind of blow back from that endpoint for each month, from how many new deals that we want to win to therefore how many deals would we need at each of the stage in the prior months based on their cycle times and based on the conversion rates. And so we ultimately reach a stage where we really have a set of targets here that aren't just kind of like, executive gut checks, but are actually built on a model of your funnel analytics and your funnel performance over time, so that we have a much more clearer understanding. And these are really critical because it's all about, the leading indicators. When we're focused on a window from seed to Series A, which happens to be our primary focus, it's only a 12 or 18 month window. It's very short. We don't have a lot of time given the cycle times in those different sales opportunities. And so we really have to understand this as early as possible. And as Tom was indicating earlier on, we obsess around SQOs, because at the end of the day, it's only once it becomes a sales qualified opportunity is it really at a point where your sales engine, your sales mechanisms can now successfully convert that business. So everything else leading up to that, all the other metrics are super interesting and tell us how the funnel might develop and how your strategy should develop. But SQOs is what's going to tell us whether or not you've got enough opportunity in your pipeline. And so at the bottom, we look at how much new pipeline is being added per month. And then we have a rolling 6-month window where we look at everything that is due to close in the next 6 months. and we look at how that is progressing and how that is growing over time. And then as a rule of thumb, ideally, we want to be in a position where that 6-month rolling pipeline is at least typically 3 to 5 times what you expect to actually close in business in that same period. That's our kind of rule of thumb to tell us whether or not this pipeline looks like it has the capabilities to support the business that we're expecting from it. So let me just stop there. Any questions on this part of the TOFU exercise? And by the way, in this, we're going to send this document out. Everything in here is a little manufactured to demonstrate the points. So if you do all the math, you might find that some of the math doesn't quite add up, etc. But it's really here just to help illustrate what we're looking for. And you can see some nice growth in MQLs, SQLs, and most importantly, in those SQOs. This would be a company that is actually in good shape as it continues to grow its business. Although I don't know what their forecast is, so I don't know what the what we call pipeline coverage, which is the 6-month rolling pipeline to forecast ratio is.
David, is SQO part of the sales funnel? Is it a stage in the sales funnel?
Yeah, so typically there's in the sales funnel, there's maybe 3 stages that you're going to see. SQL is often where a BDR has been, a business development rep or a sales development rep is engaged, such that at that point they have spoken to or communicated with the prospect, and they're saying yes, it is a qualified lead. SQL is also used to identify those leads that have come bottom up from an SDR process, where you've actually done outbound calling, and the BDR, SDR, people tend to use those terms interchangeably, has said, yes, this is a qualified lead that I'm putting into the sales process. The next step is what we would typically call, it's not shown here.
I think many of you are the BDRs and SDRs, right? You're the one actually having those first conversations. So
But the point that I was trying to understand, David and Tom, is you made a point earlier that you need to have really defined attributes as to when an account moves from one stage of the funnel to the next, right? What makes an account go from an SQL to an SQO? What are the key attributes that you're looking for that would qualify an account to go into the SQO?
So does anyone use content marketing, like white paper downloads to generate leads? So you do, okay. So you see someone downloaded a white paper. What is your business?
We make a course registration product.
Course registration product. Okay. So someone downloads a white paper and you look at their info that they filled out, and it's a Gmail address, right? Not a marketing qualified lead. You see that it's trinitycollege.edu. Maybe in your ICP, maybe not. So that's a qualified marketing lead. Then David, like, what would bring it to an SQL, and then what would bring it to an SQO in that context?
Right. Well, the
You know,
difference between
it's a potential customer just because of the domain.
right. So there's an important difference, an obvious one, probably in the M versus the S, right? So the M is typically a marketing defined stage. Agree with everybody, but it's marketing saying, yeah, they did these things. They qualified as a marketing qualified lead. Once you get to S, it's your sales force, whether it be BDRs or the actual AEs themselves, the account execs, who are now saying, yeah, no, I've spoken to them. And I'm saying that it's a qualified opportunity. So for an SQO, though, there'd be rules like, do we understand who the champion is? Do we understand what the buying process is? And have we been through that with the champion? And we have some understanding of when that is likely to happen, such that we can put a close date, and we have identified the need and the potential value of the opportunity, such that we can actually ascribe a value to that opportunity. And it may go further than that, but those are some of the basic ones that would take you into an SQO stage. Some people will put a bit of a time limit on it, which is like, well, and it's going to close within the next 3 months in order for it to be a sales qualified opportunity. Just depends a little bit on your sales cycles and your sales process, but you get the idea that there's a rigorous representation. The psychological representation is really important though, because at this point, your sales team is saying, oh my God, yes, this is an opportunity. I've spoken to them. I want to work on it. It's qualified. I am capable of forecasting it at a certain value and a certain close date. So they kind of own it at that point. And one of the things we encourage is to measure your marketing team, even if they get variable comp, base it on the number of SQOs that they're creating, not the number of MQLs that they're creating. What matters is how many qualified opportunities are you getting into your sales pipeline. That's what marketing has to be focused on, not potential vanity metrics, as Tom was saying, around MQLs, which are easily manipulated. SQOs is what counts. That's where the revenue traction is. Okay. This will be fun. Let's see if this works. So one of the things that we like to get folks to really focus on is the funnel and the funnel analytics of how you move from stage to stage. That's what requires that cohort-based analysis. And then how you can actually optimize your business based on really understanding each of those stages. You know, we have a tendency in the early days in a business to just think, you know, hey, I need to create more leads, just create more MQLs at the top of the funnel. And we don't pay enough attention to what's happening in each step in the funnel. So we created this little fun document, little fun tool to use. So let me just, I'm gonna have to come out of here. Oops, sorry, I have to go back up one. Bear with me a minute whilst I come out of here and show you this. Oops, nothing set up when I should be. Here we go. Here it is. I'm going to make this.
Can you zoom in on your?
Yeah. Can you guys see that?
Yes.
Yeah.
Okay. So this is a page that's in the PDF. You can click on it and you can go to this page, and it's just a little fun tool that lets you play around with some of those metrics to see what kind of impact it has. So it's been filled out with some basic information, but when you click on this, you can fill this out. You can change it to whatever you want that represents what's happening in your business. But here, I just wanted to kind of illustrate. And you know, so many of us in times gone by, at least, have been obsessed about tripling the business. I want to triple ARR as a business. And so the typical mode is like, okay, I need to drive 3 times as many leads into the top of that funnel. But actually here, we just wanted to look at, well, what would happen if you just had 100 leads and you stayed with those 100 leads? And these conversion rates are actually what we often see in early stage businesses that haven't optimized these stages, that 30% conversion from MQL to SQL, 60% to SAO, sales accepted opportunity, 70% to SQO, and then it can be as low as 15% from SQO to 1. And on the right-hand side here, it's just representing some different ACVs for different sort of sizes of business, small, medium, and large. And so what I encourage people to do is to sit here and kind of play with, you know, well, what if I could improve these stages? And just to take this example where you've got just over $1 million in ARR, if we were able to improve our MQL to SQL conversion rate from 30 to 45%, so I'm going to crank that up, already you start what that would do for your ARR. If I could also improve the mix of deals by changing the marketing focus to focus on those larger transactions, if that's my preferred business model. So I'm going to take my medium up to 30%, and I'm going to take my my large from 15 to 20%. So now you can see I've almost already doubled my ARR. And then with the right training for my sales team, I can significantly improve on this SQO to 1 rate from 15% to 25%, which would be frankly on or below a typical market outcome. And once you don't have to sort of really buy into each one of those, what I want you to see overall is that by just focusing on the funnel and the analytics, I was able to triple the ARR by changing the mix, improving those conversion rates between those stages. So I provide this for folks just to kind of have fun with, to really bring home to them what the value is of focusing on those funnel analytics. So hopefully you guys can have some fun with that. Let's go back into full presentation mode here. Okay, so let's get into the media part of the dashboard. And I'm going to start on the right-hand side, and I am going to zoom in on this if I remember my No, it's not that one.
Command Option Plus.
Command Option Plus, Control Option Plus. No, Command Option Plus. It's not
You
working.
have to come out of full screen.
Oh, that's right. You have to come out. See, there we go. Hang on. Okay, and I'll make this full screen. Man, it's a lot of buttons here. Okay, so how's that looking? Can you read that?
You should do one more.
Oh, that's
Okay, that's
good. All right. So if you learn anything from today, it'll be it'll be that keystroke combination. So this looks a little bit further down the funnel at a number of the typical metrics that we would track. We track many more than this, but this is typically what we would have in our sort of prime, what we call our prime dashboard. So we're going to look at new logos created this month, and we're going to see how that's trending against, again, the calculation of our forecast of how many new logos that we expected to have in this budget, what's churned, and where we stand at the end of the period. And then we focus in typically on what's called CAR. So ARR, as we all know it, really comes in two forms. Most of the time they're identical. So CAR is contracted ARR. You've signed a binding agreement that represents that annual value of revenue, of recurring revenue. And LAR is where your solution has gone live. So it's what we call live ARR, which means it's invoiceable at that point. And so at that point, it's a little bit closer to your revenue calculation. But mostly in an ideal world, those things are happening coterminously and they go side by side. But we look at CAR up front. So we're going to look at how much new CAR, contracted ARR, did you add in the month. Then we want to look at what kind of expansion did you get, upsell in that month. We want to look at what sort of negative expansion, downsell you might have had in that month. And of course, we want to understand what churned. And the combination of all of those together is going to tell us what is most critical, which is how much net new ARR did you add in that month. And then, of course, your CAR will increase based on that value. So it'll be whatever it was in the prior month, plus the net new from this month is what's going to deliver you this, plus this is what's going to give you your CAR for the following month. And of course, again, we will have our overall budgeted targets for that and see what we've achieved against that number.
Hey, David, one comment on churn goes to your point, Matt, earlier. Customers, especially early customers, churn for all sorts of different reasons. The gentleman who has SMB customers, bankruptcy, customer who is bankrupt, right? It's a little different than a customer replacing your solution with a competitor. I was just in a board meeting with an SMB focused portfolio company, and the founder just had a 25K churn, no commentary, nothing. Of course, as a board member, I'm like, that's not good. He said, oh, they went bankrupt. There was nothing we could do. And I was just like trying to coach him. Context is very important, not just for your board meetings, but for pitching. Dissect the churn if it's there and explain like, well, we tried this market segment early on. We saw that customers were churning. So, that's part of most of our churn is an old cohort that we don't focus on, or unfortunate events, and really focus your efforts on the churn that you could have controlled. And then look inward. Did we attract the wrong kind of customer? Did we price it wrong? Are we not competitive with some other solution? And then try to work on those core issues. But yeah.
I confirm that churn just means lost.
The question was, does churn mean lost?
Yeah, you lost that business, basically. I'm sorry, I'm just not familiar with that term.
Yeah, typically it's a customer who stops using and paying for your product.
Okay.
Downsell is if you can imagine, let's say you sell to Google and Google just ripped 20% of their employees, they may downsell by 20% if you were, a workstation product for them. So they haven't churned, but they contracted.
Makes sense.
Did I get that right, David?
You got it right. And I just got to reinforce the point that you were making. Again, this term we often use of good revenue, which is all churn isn't bad, particularly in the early stages of the business when you're trying to work out what the optimal segments are that you want to build your business on. And quite often, again, in that early seed stage, we would have closed just about anything that came into reach. And so we may end up with a lot of customers who either are churning by their own volition, they're just not a very good fit, or frankly, who we might want to help churn out. And so we might want to change our pricing and packaging in such a way that those folks are, those ones that we don't want in that are at high risk will actually self-select out in the business. But the ones that we do have, we are bringing into a higher confidence of revenue. For instance, not atypical where we invite portfolio companies to shift that particular product class to annual. So as an annual commitment, they have typically a much better, higher retention rate, not least of which, of course, is 12 months anyway, as a retention, but they typically are more committed to the product. They have faster CAC payback because they're paying for the full year upfront. So it really improves on all of your metrics, and it helps to basically wash out those customers that aren't going to contribute to the good revenue business that you want to build going forward. Looks like there's a hand there.
One more hand.
Are you counting returning customers in new, or would you want to see returning customers in separate sort of category because that's showing a different level of maybe commitment?
So the question is, are we showing returning or renewing customers in new?
In new, no. So you're sorry. Actually, let me not be so quick. Renewing customers are not in your new. Returning customers, somebody who might have churned, stop using your product for 6 months, and then come back again. Right now, typically would be shown in new, but I have worked with companies where their business is more kind of episodic. So one company I did litmus email testing service, where people would run big campaigns in certain parts of the year. So they would come and use the product for 3-4 months, and then they would stop, and then they would come back for 3-4 months. And so there we created a different kind of episodic churn calculation, which was those customers who came off and then came back on again. To Tom's point, you know your business, so you need to present it in the right light. You need to help everybody else to understand. And not just blindly follow the metrics. You need to make sure people understand what is contributing to churn, whether it's an acceptable behavior or whether it's an unacceptable behavior or not preferred behavior from the segments that you're chasing. And one of the ways you can do that is to create a classification of churn, which I've done in the past.
So using this sheet, if you start January with 61.7 of ARR, and a customer renews at the exact same price, your ARR isn't changing, right? If they expand, it would be reflected in the upsell line.
I think I was thinking more about the episodic.
Oh,
just
yeah,
around
yeah.
holidays.
Oh, okay. You have a seasonal business.
Sometimes.
Okay.
Yeah, that can be fun. Okay, so we'll continue. Page. So that gives us an understanding of our overall car, and then specific to this conversation, we're going to want to track what's happening from a logo churn rate point of view, and then also what's happening from a net revenue retention. Remembering net revenue is the cohort. I generated this much revenue in the January cohort of the prior year, and then when I look at the January cohort of the next year, how much did I generate, and that will give me my trailing 12 months net revenue retention, and we're looking for something that's 105% or greater. And again, in this early stages, you could have some high logo churn rate, as we were just saying, but honestly, it's because you're shifting into a focus on a segment that is better, maybe seeing some of the prior segment wash away, but ideally, your net revenue retention is going to be north of 100%, and that's what's really going to drive this SaaS engine going forward. So a couple more key metrics that we would typically look at in this dashboard. Every time you sign up a new customer, we want to calculate what's the average revenue per account for that new customer and look at it in comparison to what's the average revenue per account overall. And so here, what we're looking for typically is a growth in that ARPA as you continue to get better and better at targeting the customers that deliver the best outcome for the business. And so you can see here as we go around towards the right, you start to see that happening, particularly in the latter months. And quite often in your board discussions or your own internal discussions, you develop the color commentary here that helps us understand what is happening in these metrics. If we see them in isolation, we're going to form our own opinion as best we can. So when you're sharing information, you can sometimes add comments in, things like that into your dashboard that make it easier for people to understand.
David, can I just ask one other question? A lot of our clients, especially in the SaaS world, will start with a business who wants to pilot the program, right? I just want to try it for a few months before I roll it out. And I may pay for it on a very, very limited basis for the first couple of months. How does your analysis look at pilot revenue and then full-blown revenue in terms of net revenue retention and new ARR?
Yeah, so first of all, we always try to get our companies to structure their contracts in a very specific way. Instead of a pilot contract, and then 30 days later go negotiate a real contract, what we try to get our companies to do is a 1-year contract, say 30-day pilot period with the customer has an option to cancel, right? So first of all, you're actually testing, are they really ready to commit to the pricing we need to deliver this product? And 2, are they serious? Are they just running a science experiment in some internal lab, or is this like looking at this as a mission critical business tool? And so I would always push for that. We'll do a 1-year deal. You can make it free for 30 days and you can cancel at any time. But it forces that rigor of that negotiation for the full deal up front. And some customers will go for it. In fact, interesting, if you're selling to enterprise, sometimes your deal champion will want to do that because he does not want to go back to procurement and back to legal and back to the CFO like a second time. He just wants to like get his tool or her tool and be done with it, and then have the sort of assurance that they can cancel if they need to. SMB is a little different, where like we have some SMB focused companies where they experimented with free trial, freemium, self-serve onboarding. A little different because the numbers are greater, so you see those early churns. We call it, they track first 90-day churn as like a key metric for them. And then that helped them inform basically who not to let trial the product, because they got enough data where they said, oh, if it's a company of less than 5 people, they will churn. So don't even let them sign up. But yeah, so if you were just going to do a 30-day contract standalone and they don't renew, you're going to see new ARR, right? 1 month, and then you're going to see churn the next. So it doesn't look good, right? And then you have to ask, well, why? Why did they churn? Could we have prevented it? But sometimes you can handle it in the contract structure.
One of the things that one of the companies I ran was we implemented a money back guarantee. So you signed up for a year, which got us our money in advance, which is great. But the person that we're dealing with is hesitant about the risk of a year's revenue or a year's cost being out there. So they need to go back to their boss and say, look, if it doesn't work out, we're going to get our money back. And so we were very, very scared about putting in a money back guarantee. And after 2 years, I think it was like 3 or 4 accounts that actually came back and asked for the money back. And so the risk that we were perceiving actually didn't happen. And I'm just wondering if you've had similar pricing models with some of your companies.
David, I don't know that we've had like full year guarantee. Like I said, we've had this staged approach where they can cancel after a period of time, but not risk-free.
Not risk-free.
I don't think.
I have seen it. back at that company Litmus again in a moment, but so a couple of comments on it. If you have a money back guarantee, you, by the strict interpretation, are not going to be able to recognize that revenue other than as MRR, by month, and so you won't be able to recognize it as ARR. If you've built a track record of running accounts through that process such that you can demonstrate over a reasonable statistical number, which many of it can't at this early stage, that there's a very low probability of that. You can either accrue a 10% or some sort of risk buffer on your ARR, which you sort of allow for that potential across the entire new ARR to potentially churn, and you account for it that way, or you just identify it and it's an acceptable risk. And when we were at Litmus, we did have that in our annual account. It came from a sort of cultural heritage. It wouldn't be there if I could have helped it, but it was there already. But we were doing thousands of transactions a month, and so we were able to show statistically that it didn't represent a risk to revenue, and so it was acceptable to all on board.
So Matt, how many of those contracts actually did they have to refund?
We refunded we were signing about 1,000 accounts a year. And we had a refund about 3 or 4.
Oh, okay, just build it into your loss rate. And
Normally what it did was it allowed you to, if somebody called up and said, I want my money back. What they're saying is that there's a problem with the account of the delivery, which gives you a chance to fix it before you give the money back. So we found that there was really only a couple customers who were absolutely dead set on not telling us why they wanted the money back, but they requested it and we had to give it to them.
just, yeah,
Yeah, one question about that, David. You said that if it is an annual contract, that they were to pay upfront, but they have some sort of option to do it risk-free, that you could not count it as true ARR, but it would be MRR. Can you just explain that? Or maybe
Yeah, well, because in order for it to be truly ARR, there has to be no possibility of reclaim against the monies paid upfront. And in this case, we're explicitly saying there is a probability, there is a possibility you have a right to refund. Now, there are ways in which the refund can be done as well, creating credits against future and things like that that can help defray some of those issues. And again, as I say, if you've got statistical record of having done this thousands of times and, less than 3% of them ever do, and then maybe you actually accrue a loss in your accounts to allow for that 3%, then, your auditors may be comfortable with that.
but it would count toward contracted ARR.
It would count towards contracted ARR. And ARR is a bit of a nebulous, it's something that we use. At the end of the day, really the sort of hard metrics are around revenue, where it is accounted for on a monthly basis.
Just one operational topic around churn. You all are software companies, right? For the most part, yeah. You should definitely instrument your product so you know what the usage looks like, because if people are not logging in and using your product, the chances of that being a churn on renewal is exceptionally high. And it actually gives you a reason to reach out and ask them if there's a problem, see if you can help, get them through whatever issues are keeping them from using the product. So again, it's not related to the KPI dashboard, but we would call that a customer success function in a larger company. But stay on top of that, because if they're not using it, they're not going to pay, guaranteed.
And probably maybe obvious, but if there is any kind of refund, at most it can only be for the outstanding period, not for the period already expired. So if they've used it for 3 months, then the most that they would be able to claim in a credit back would be 75% of the annual value, not 100% of the annual value. There is a question in chat that has come in. Tom, I'm not sure if you've seen this, but it might be one as well for you. So it just says here from Jordan, some basics about companies having both recurring and non-recurring revenue. Question 1. What do you define as a SaaS company regarding the revenue mix, or said another way, how much revenue must come from recurring sources versus non-recurring sources? is there a VC? I have an operating number on that, which is like anything above 30% that's non-recurring. It's hard for me to think of it as a SaaS business, but I don't know if there's an out and out rule on that, Tom.
Yeah, I mean, this is one of those areas where you're gonna read diverging opinions with different VCs. So at early stages, I think it's all about survival, right? And if you can get revenue from a different bucket through services or onboarding fees, like take it. Don't worry about optimizing the SaaS portion if it's going to be an uphill battle. And in fact, it is true that money for like licensing and money to provide professional services often come from two different budgets if it's a large enterprise. And it's crazy. It's like we've had companies struggle to get a 25K license deal over the line, but you show them professional services to kind of do the same thing, and it's like different discretionary budget gets done. It's gonna hurt your metrics here, but sometimes it doesn't matter. Like you need cash and you need the account and you can fix it later. So I'm of the mind, just do what you need to have, do what you have to, within reason. And oftentimes services are directly linked to retention. So if they need help implementing your product or maintaining it or training or lots of things, like that's driving usage and making a happier customer. So we're in the camp that we think services is a good thing. I can show you 5 blogs from some Silicon Valley VCs who say like you should have it all needs to be recurring or you're dead to us.
And you can bundle those services into recurring revenue streams, premium support offerings, for instance, that maybe also includes some services in there that will actually sort of help bring it into more of a recurring model. But as Tom says, in the early days, you need to build a business and you need to get the cash. So you need to do what you have to do. But you're going to want to show over time, if you want to enjoy the valuations that are attributed to a recurring business, a recurring SaaS business, how your business is likely to change over time, so that people can understand how to assess it in terms of value growth. And then a related question was, how do VCs view early stage SaaS companies that use non-recurring as a glide path to invest in the recurring part of the business, pros and cons? HubSpot early days. I think maybe we already touched on that, but I don't know if you had anything more you want to add to that, Tom.
So services business transitioning to SaaS model, is that kind of the gist of the question?
I think you actually answered my question with your commentary on the first one, which is basically do what you have to do, but ultimately show a path toward a larger percentage of your revenue coming from recurring.
I know there's a founder in the group who has had a services business and is launching a SaaS product based on the learnings of that services business. And there's definitely some proof points that you're going to have to build to attract a SaaS investor, right? You're going to have to start to get some annual contracts and usage on the platform that doesn't involve your engineers custom developing, every aspect of the product, that sort of thing. But that's just time.
Okay, so I'm going to move on to a couple more metrics here that we typically use. Some of them have different degrees of value depending on the evolution of the business. So CLTV is customer lifetime value. Again, you're going to look up and see lots of different ways to calculate that based on the churn rates. But one thing we do, or at least one thing I do, is usually put a 5-year window on the SaaS term, so that you don't end up with sort of ridiculously long, crazy LTV. So you're only ever looking across a 5-year window. And we look at the ratio from customer lifetime value to customer acquisition cost, CAC. And the rule of thumb here is about north of the 3-to-1 ratio. But one thing I think is always a little bit difficult in these early stages is it's hard for you to really get to understand what your CAC is going to be. So your CAC is always going to be really high in the early days, right? You're just building the business. You're just starting to get a volume. You're just starting to improve on efficiencies. It's not that you should ignore it. It's a critical metric, and particularly when you start looking at CAC payback. But it's not going to look good early on, and it's going to lead to some numbers that are going to look way out. And I don't think you should lose too much sleep. But again, you want to steer people who have been trained to look at that number and see something that's north of 3. You want to train them in why you think this number is where it is and how you think it's going to trend as your business matures.
Hey, David, what goes into CAC? And if the CEO is selling or partially selling, does that get included? Does the portion of their account go in there?
Good question. So typically what goes into CAC is all of your sales and marketing costs to acquire that customer. So that includes on the marketing side, all of your marketing programs that you run. And typically I include the marketing personnel costs, but again, you'll find some debate out there as some people just identify the marketing programs. Whatever you do, you need to make sure everybody understands how you're calculating it. In the early days when you are founder-led and sales-led, I would include some portion of your founder CEO costs if that is the primary way in which you're generating your revenue. Otherwise, again, you're going to get this sort of misleading perspective on how efficient you are when actually 50% or 70% of a CEO's time is being spent on driving those sales in the early days. Until you brought a sales leader in and a sales team, and you can actually successfully say, I've moved all of that work effort into that team. Okay, one thing you'll see this notation T3M and TTM. TTM is trading 12 months, so it's looking back on a metric over a 12-month window. T3M is looking back on a 3-month window. And the trading 3-month numbers are really important because in this early stage, if you're always looking back a year, it's like a lifetime for the business at that point. And so you want to look at yes, the year, but you also want to look at the trailing 3 months so you can see how these metrics are trending over time. Are you moving in the right direction? Are we seeing that? And can we play to those strengths? So another popular metric is the SaaS magic number. And again, you got to look, there's a lot of different definitions on this. So the SaaS magic number was typically used for an investment tool with public companies where you couldn't actually tell what the ARR was because the only thing that was published were quarterly revenue numbers. And so what you would look at is what the growth was in the current quarter in revenue. And so you take the end of the quarter, beginning of the quarter, look at the new revenue that was generated, multiply that by 4 to get a proxy for what the ARR was for that month, and then divide it by the prior quarter's sales and marketing costs. What that is meant to do is tell us about the efficiency of your sales and marketing engine. So as you're investing dollars into that specific category of spend as a business, what is the return that you're getting back? And really, you should look at not just the revenue, but the gross margin. So take that revenue number and multiply it by the gross margin, and then look at that ratio. And if it's 0.75 is a sort of, a rule of thumb, if it's above 0.75, then you've got an efficient sales process. If it's much above 1 or 1.25, you're under investing in your sales organization, and you need to invest more in order to maintain.
Too early, it might be junk. And so 500K ARR, you may not get meaningful numbers out of this, but as you scale, that becomes more important.
Yeah, in fact, I'm going to move on from it. Gross margin, however, is hugely important, and not enough attention gets paid to it often in the early stages. And so we typically in a SaaS company are looking for gross margins that are ideally 80% or above. 75% is maybe the watermark that we would be looking for in that SaaS business. Again, it comes down to the question that we had at the very early part of the discussion, which is what goes into cost of goods sold. And that's going to have a big impact, the primary impact on your gross margin calculation. So a couple of additional comments on gross margin. In the early stages of a business, quite often in building that SaaS business, we've cobbled together all kinds of infrastructure in order to just get our product out to market. And we don't always pay enough attention to how we can drive down those cogs. Now that we understand how and have gained more maturity in the business, now that we understand exactly what components we need, can we go back and restructure some of that infrastructure to deliver a more efficient COGS platform? Can we go back and renegotiate, particularly as we start to build volume around our business in order to lower those cost of goods sold? The second point we mentioned earlier on, which is there's a tendency to lump all of your customer success folks into cost of goods sold, when quite often those folks are doubling as almost sales engineers and are playing a role as part of your sales function. And so you've got to find a way, timesheeted or otherwise, of just understanding how much of their time is really being spent supporting that customer, and how much of their time is really being spent not just in acquisition, but in expansion or upselling a customer, to make sure that you've got the right number there. Try not to just kid yourself. Try not to just force this gross margin up if you're not accurately representing, because it will come back and bite you somewhere. But this gross margin is the biggest single point of impact on your runway, and quite often we don't pay enough attention to it. So every dollar, every percentage point that you can improve on that gross margin creates dollars that will increase the runway of your business. And as with most things at this stage, the most important resource that you have at your disposal is time. So higher gross margin means longer runways, means more time for you to execute and build on the business. That's my diatribe on it. Tom, I don't know if you've got anything that you'd add around gross margin.
David, we got about 30 minutes, so we know we want to leave time for discussion. Do you want to?
Yeah, I just got a couple more slides we can pretty much zip through if we're good. So obviously we're going to be tracking cash balance with you to understand what's left. Runway is a really important metric. We really encourage whoever's running the financial organization to be the guardian of the person who creates the runway, because they're the ones who really have to make some of the key decisions around where the risk profile is in terms of new revenue, and we don't want to be automatically doing that through calculations. So we work with the CFO to create the runway calculation. You just don't see it on here. But the last big metric that you'll hear a lot about is burn multiple. And here that's looking at the last trailing 12 months. And so burn multiple is going to look at how much cash you burned in the prior quarter is the denominator, and the numerator is how much net new ARR you generated in the following quarter. So what I burnt in the prior quarter versus what net new ARR I generated in the next quarter. So that combination tells us the efficiency for every dollar that you spent in the prior quarter, how much ARR are you generating? And typically we would look for a burn multiple less than 2. In this climate, you want to be 1.5 or less, because capital is just that much harder to come by. It's not just that by doing that you extend your runway, but you make yourself way more attractive to investors when you're able to drive a business with that level of capital efficiency of 1.5 or less. On that, so I'm going to just bear with me once I return this thing to, I've got all kinds of things blocking my view here, so hang on a second here. Okay, I'm just going to go back into presentation mode. Okay, sales forecasting. This one's always good for a bit of debate. In fact, even Tom and I had some debate around this. So I'm gonna give you my rule of thumb around forecasting, having run sales for a while. We like to have our folks produce forecasts in the following categories. So some is obvious. The first is closed. How much business is closed? Obviously, all paperwork executed, reviewed, and agreed upon by your financial authority to be recognizable. So just because you got the paperwork signed doesn't necessarily mean you actually had a contractable event. So the CFO or whoever's heading up finance has to make sure that yes, this is a recognizable event and that's our closed business. Then we look at commit, and this is what I look for in commit. So this would be, let's say if we're talking about a quarter, this would be that the sales manager expects it to close in that period. So we're looking for the forecast period of a quarter, that you have red lines are complete, or at least all the major issues are deemed to be resolved. So you may have a little bit more cleanup to do before the final budget, before the final contract is done. That there has been budget identified, originally associated with this or purloined from somewhere else in the organization. And that we understand and we can track the buying process. We understand the paper process of what needs to be done in order to deliver on that overall revenue. And that's what we would consider to be commit. Then you've got best case. And in best case, how I look at it is there is a mutual expectation that it will close this period. That means both you and whoever your champion is typically in the organization are both expecting that, yes, this will close. Not just that you as a salesperson are saying, I think it will close. There has to be some evidence that you could defend, if asked, on why the prospect also thinks it has closed. And one key indicator on that is that you've at least started your red lines. So if there's no contractual purchasing movement, that usually is a bit of a red flag, and I wouldn't put it in best case. Here, the budget again has been identified, and we understand the buying process. We may not be able to track it all. That's why it's in best case and not commit, but we understand it. We understand what is required to be done. The third category has a name that can cause a little bit of confusion, but we call it pipeline. It doesn't mean your entire pipeline. It means what's the pipeline of opportunity that will close in the forecast period, a quarter. And here, what I look for is that there's mutual agreement that it can close this period as opposed to that we expect it. So your champion might be like, yeah, I think, it could happen. There's a few things that might go wrong, but we think it could happen. We're tracking to that. That your champion is committed to closing to the quarter, i.e. they're putting all their effort into try to make that happen. They can't guarantee it for you, but they're trying for it. And you have a deal size, which is also in all the other stages, sorry, but this is when it has to be, you can't get into the pipeline unless you have a deal size allocated to the opportunity and that the budget is identified. And again, we need to understand the buying process. And what I do when I, look in a Salesforce based on these categories, and I look at the quarter or the month, whatever they're committing to, or whatever they're forecasting for, I will look at closed and commit as if it's 100% going to happen. I'm taking the sales team's word for it that they think this is really going to happen. So I'll count that at 100%. And then I take everything else and I take 30% of it. And I look at those two numbers combined and see how close they are to what the sales manager is forecasting for that period. And it's not a projection, it's just a confidence check for me to understand, based on a lot of experience of what happens in best case and pipeline, how much of that you think will actually translate into business in that given time period.
This is also a great framework for when you're pitching for money. So a lot of our companies fundraising are in it for about 6 months, if not more. And the VCs are just sitting back and tracking them, right? And so if you just present one revenue number, which has got a high variability of you achieving, right, especially 6 months out, if you present sort of your high confidence, think of this as like stretch goal and the stars all, and you break it apart, you want to make sure you're always hitting your target, especially always. That would be great, but especially when you're engaged with venture capitalists, because the last thing you want to do is 2 months into the process have to tell all sorts of excuses about why you missed your number. Much more tolerant if the best case number slipped because you presented it as sort of best case and yeah, things didn't line up, but you get a lot of credibility sort of at least in that period of time when you're being very, very closely watched under a microscope. So you don't have to use these exact terms, but for your overall company revenue, as you're pitching, I really recommend breaking it apart like that. Okay, just a couple more slides here.
So there was some question about pricing and packaging, and rightfully so, because there's nothing more impactful, frankly, than getting this right, or at least starting the journey, because it's not a single event, it's a journey. What I've done here is is included some different resources that you can click into. So when you get the PDF, if you click on this first one, it will take you to a couple of blog posts that we put together with a gentleman, Brandon Hickey, who actually runs the pricing and packaging for LinkedIn. So he's been doing this for a long time and has a lot of experience, and he did a really great job of talking about the different ways in which you can implement that pricing strategy and the stages that you go through and the process that you go through of how to evaluate it. So I'm not going to try to do that here in 3 minutes, but I'd invite you to click through on those links and consume that content. But the last link is something that I'll spend a few moments on, because we just put together a workshop that is actually available to everybody out there. We did this with folks from Applied Frameworks, Luke Homan, who we know well. He's a venture partner at Companyon. We've done a bunch of work with them before around product management, and they brought a very systems approach to helping you work through your entire pricing strategy. And I've spent quite a lot of time with various firms out there looking at different pricing techniques and support. Many of you probably know, kind of almost locally, Price Intelligently is a firm that's done really well in this area. And they do lots of great work around what we call willingness to pay, which sounds really critical, but it's actually only one small part of putting together your pricing strategy. And what this workshop does, and we worked with them to build it, is takes you through a much more holistic process. And it starts with understanding your go-to-market strategy. And all of the segmentation that we talked about earlier on becomes a driving force in your pricing strategy. It's not just a good, better, best, or small, medium, large. It's really around what segment and what use case you're striving for in those organizations, to which persona. And so they help you think through how you want your pricing to support that overall strategy. And that strategy might include, for instance, I want to onboard a significant part of the population of my ecosystem, maybe even a limited cost or low cost or free usage, but that part of the ecosystem is going to build the reservoir for me in my overall strategy. So we want to put together pricing and packaging that reflects exactly that, and then explicitly drive the structure for those different segments, for those different use cases, and for those different personas, quite often with editions of the product that are actually named explicitly to align to those use cases and segments. And of course, you get into all the specifics, in particular, what are the value metrics that you want to base your pricing on? And so is there a clearly and easily understood and traceable metric that your customers relate to when they think of the value of what you do? Not necessarily what you think of the value of what you do, but what they think is the value. So if the value of your product is to make their salespeople more productive, then obviously the number of salespeople that are engaged on the platform is probably going to be one of those metrics that would be valuable. If their metric is to run a marketing campaign more efficiently, then maybe the marketing campaign is the metric. If their real desire is to engage a specific and growing audience, then maybe the number of customers under management is the metric that is your value generator. And you can have more than one. And the art form is.
Let's move on, because I think we're just running out of time.
Okay.
And,
well, actually, we're right at the end. So the last thing I'm just going to finish up on here is, so here we actually also put together a benchmarking tool that uses the OpenView SaaS benchmark analysis, but lets you go in and put in your own information so you can see exactly how you're performing against your peers based on the size of your business. So I invite you to click on that link when you get the PDF and try it. And then finally here, just put together an array of resources at your disposal that can help you through nearly every question, including a wiki that we put together where we've kind of brought a lot of this material together in more consumable groups. So let me stop there.
From the benchmarks tool, it's really great as you're doing your 3-year projection. When you might be at a 5 or a 10 million theoretical run rate, it'll actually benchmark your projections against actual companies at that run rate. And you'll see where you're just way off, and you can adjust to have like sort of normal looking company that when VCs challenge you about how realistic is it, you could say it's all within band of, 5 to 10 million ARR companies out there. So it's great for forecasting as well.
So open up to whatever way you want to handle, if there are any other just general questions and general discussion. People already done.
Can I just ask, I mean, we are asked often about valuations and what is to be expected. Changes in the marketplace right now that people are sensing, but maybe not actually seeing. I mean, from your perspective, what are the valuation range that people are looking at, and has that changed at all over the last 6 months?
Yeah, it's a tough question to answer because again, if you are building a chat GPT competitor right now, you're probably not feeling those valuation effects. What we're seeing, well, I'll tell about what we do as Companyon. We're being way more patient. Our investment thesis is to invest in companies between 1 and 3 million ARR. Right now, we're focused mostly on companies between 2 and 3. Right. And we're taking our time, and we're just doing more in-depth analysis and research before we go to a term sheet. Our graduates are experiencing the exact same thing. We had a company actually just get a Series A term sheet. They grew 5x year over year, great metrics across the board, and it's a flat round from our investment, right? We had a company do a nice up round at the B stage, but not 20x ARR. It was like 7x ARR. More mature company, approaching 10 million. So it's more sober, but I think if you just rewind 3 years, it's kind of like what it was like back then. Maybe 4 years. So there's this whole, I don't know, there's sort of this transactional approach that a lot of founders have to fundraising. Like, let me show you my deck, you go in my data room, and then you tell me if you want to invest. The game now is that they're doing a lot of tracking. Let's get to know you. Let's see how the business develops. I like what you're showing me, but is it going to materialize over the next 3 or 6 months? Hence the approach on sort of how you present your financials and the forecast in the near term. Very important.
The key there is doing what you said you were going to do, right?
Do you follow through, right?
And did you approximate what you're forecasting?
The founders and I'm a multi-time founder myself. I always had like very happy years about what customers are telling me, and I translate that to my forecast. I always missed. Don't want to do that. Pre-seed and seed valuations are actually less impacted than Series A and B. We're still seeing companies getting seed funded, depending on the company, between 10 and 20 million pre-money. Plenty between 0 and 10 million as well, but it's so situational. The thing I would encourage you guys is investors now, for the most part, with exceptions for like geographically focused funds like this one, there are VCs in every city of this country who will look at a Maine startup. They're all on Zoom. Half of them are have moved to Florida or Costa Rica anyway. And frankly, to have the Maine sort of economy, I'm sure engineers in Maine are less expensive than Silicon Valley, Boston, and New York. Like, that's a real asset for an investor. So really trying to just break beyond New England is what I would suggest more than anything. And it requires a lot of research, a lot of Googling, a lot of mining your LinkedIn networks. But every day I learn about a new fund in some city with some thesis that's applicable to our portfolio. And I'm like, oh, wow, I wish I knew about these guys a year ago. So it's all about just getting the exposure, and just getting out of New England for you guys in particular is going to be really important. So I kind of just totally dodged your question, but there's no answer. Just. Getting the money is one thing. At what at what valuation should probably be your like secondary concern, because it's gonna be whatever the market rate is.
But what I'm hearing in the answer is that companies should expect that the courting period with the VCs is going to be longer than it has been in the past.
Yeah.
And your performance during that period is now critical.
Yeah. We're gonna do a whole session on like how to qualify a VC, or more importantly, disqualify. Plenty of VCs will track you who have like little interest in investing in you just because you're interesting, they like you, they track your sector. So you want to ask like a bunch of questions early on, like what is your process? How many deals a year do you do? What would you need to see from us to move into pre-term sheet diligence? What's your criteria for term sheet? Like, they're happy to answer, just no one ever asks. And when we have a first meeting with a company, I just kind of lay it out because I want to be transparent. You know, we look at 50 companies a week and we do 4 to 5 deals a year. So I just always want them to know what our process is like so they know what to expect. And most VCs just hand you the mic and say, tell us about your company. Hey, thanks for sharing. We'll follow up. Like how many of you guys have heard that? Yeah, we'll follow up next steps if there are. You should spend 5 minutes like really digging into figuring out if there's even a remote chance of a second meeting, let alone an investment. I'm not proud of my industry coming from founder and being just beaten up by VCs for most of my career, and now being on the other side, I see some really horrible behavior, and not intentional, just ghosting. Right, ghosting is probably the biggest one. But yeah.
Any other questions? Nicole?
I have a very specific question. If you're engaging in an email marketing campaign, what type of interaction would cause you to put somebody in the MQL category?
It could be an open.
Just an open, is not?
It could be if you can. So if you have defined what your ideal customer profile is,
Yeah.
you might look at, okay, it was opened, but was it a domain name that I think might be a relevant customer? I don't know.
Yeah.
David, you're actually lived in email marketing. You might have a more.
Yeah, so it certainly could be. Typically, you want to make sure that email focuses on only one CTA, call to action, in the email. Like one of the biggest mistakes is when you put links in all over the place in an email. You want one call to action, and if they click through on that call to action, that typically is somebody who not only opens, so they're clearly interested in this topic, but they read and digested enough of what you had to say, and were interested enough that they clicked through. So then you might be starting the journey towards an MQL. Typically, it's a combination. You do the email, they click through, they go to the landing page, and then they take another action. And so it might be a couple of things that you look for before you would actually consider this to be an MQL. It's one of the reasons why we're always nervous about that MQL metric, because there's no simple, clear, consistent definition of what it's going to be. And so it can vary a lot from company to company.
I had a company that they had a lead open the email like 12 times. So they didn't do any of the CTA, and they eventually connected. It was a customer prospect. So that was just a signal, but well outside of the normal sort of what they would normally consider an MQL.
Yeah.
One of the things you might want to look into. Oh, I'm sorry.
Just don't know if that's what we should be doing.
Yeah, I would listen to him.
So one thing that one discipline that you might look at introducing, and again, we can introduce you to some folks to help you, is lead scoring and how to implement it in order to be able to assess through several combination of behaviors what you think the probability of a prospect is, and that might help you to define your MQL.
Just curious, who's out raising money either now or in the next few months? Okay.
Any other questions for Tom or Dave?
I have a question. Can you talk a little bit more about growth with new client, new logo acquisition versus ARR growth and the sort of dynamic tension between those two and how you
Right.
balance it?
New logo acquisition versus overall ARR growth. And some of the trade-offs. What's your ARR range roughly if you're
600K.
okay, 600K? So. For me, I'm gonna be very, very interested in renewals and retention, right? Because roughly how many customers? 30, okay. So yeah, churn and renewals. Because we're giving you credit for probably not having a fully staffed marketing and sales force for that new logo. But if those 30 keep coming back. And especially if they're expanding. And you can tell me what the attributes of a good customer for you is, then my gears as an operational VC, I'm thinking like, oh yeah. We can totally like build the machine to give you more of those leads and close more opportunities. What the real red flag is. High churn rate where you're getting 30, but a year later you're left with 20. It doesn't really matter how many new logos you're getting it. There's something wrong there. Yeah.
My question's on the MRR versus ARR. Our software, we're ERP kind of in a niche industry. So technically, we're considered MRR because we do month to month and we can let anybody cancel, but it's ERP, so it's sticky, right? So, I always hear the negative about MRR versus ARR, but we have a 98% customer retention rate, so it's gonna give us some little input there. And then in that same customer lifetime value, when you don't have people leave, what's that look like? So
Yeah.
questions there.
I mean, to be honest, I think in ARR, so if you told me your MRR, I'd just multiply by 12 and get an approximation. I think I would be very interested in exploring. Could you move to annual with at least a portion of your customer base? And if so, if not, why not?
Yeah,
Is it an
and
industry
I
thing
think
or-
everyone wants a discount there, right?
Yep.
And cash flow, I don't need that.
Okay, well, there you go.
So, I mean, we're not a startup. We always are creating new products, which are all startups in and of the business, but so I kind of treat those differently. But yeah, so I didn't know how that was perceived from, your perspective in that. When you have the numbers to back it up and been doing this for many years now.
I'd say most of our companies in our portfolio who have had month-to-month customers have just gone through great efforts to try to convert everyone to annual. Mostly for cash flow. It artificially helps retention, at least for the first 12 months.
But from looking at value and stuff like that, what is there a difference?
I mean, I think if you're retaining your customers and that's how they want to buy and, your churn looks good.
Yeah,
I think it's
negative
fine.
churn.
Yeah.
So,
Yeah.
yeah.
Don't rock the boat is what I
Yeah,
would say.
okay. I have a few customers that do that.
Yeah.
So, as a pre-seed startup, how do you balance the speed at which you work and close your sales pipeline with all of these against your actual team size? Like, if you have, say, 50 enterprise customers, but if you converted them, you would basically see higher churn because you can't possibly service them on the customer service side. But you need to hit those metrics to make the pre-seed investor is interested because they're asking for 50 MRR, 50 MRR, at the very least, some of them. So I'm just curious to get your take on how you balance the sort of the equation against your actual burn rate while you're actively raising plus hitting some of these metrics.
Yeah, I mean, I think of it as it's like wasted marketing spend if you're bringing leads in that you just can't service, talk to or convert. So I would dial back whatever you're doing to generate top of funnel interest and apply your efforts with whatever resources you have on just closing the most likely deals. I don't think you're going to get judged based on MQLs, for example. Okay, today it'd be totally foolish, right? Unless it's a self-serve product, which is it? I don't think it is, right?
It is right now.
Oh, it is.
We have a tier that is sort of base plans. Anybody can go and sign up and we don't, it's like, there's an onboarding day left. For the enterprise side, we actually are rolling out a self-service later this month. But the idea though is that these are, in the meantime, in order to keep up our enterprise customers, we have to sort of keep them in as a white glove. It's all word of mouth to this.
Yeah.
So.
Yeah, I mean, this, and it sounds pretty stupid, but I would just focus on getting, like, making customer number one as successful as you can.
Yeah.
And if you can service two, do two, but, you know, VCs are gonna understand that, they may have questions. Is it too hard to implement? And therefore, do you need at scale, are you gonna need a massive customer support team to just, get these customers live?
Yeah.
But it comes down to like, what's a vanity metric and what's really important, and not all VCs are gonna have that particular benchmark. It's probably one that you've been told once or twice, but. Yeah, I mean, I would say get one live, get the revenue, then get two, then get four.
Yeah.
And you will eventually get there. I don't think there's any real shortcuts, but I would definitely just dial back any spend you're making that's generating leads that you can't service. Okay.
So just to wrap, we will get the slides out to everybody. So, well, we haven't, right? So we'll get those slides out, distributed. And the one thing that I would point out in the slide deck that both Dave and Tom mentioned briefly, but all the links to the data and tools that are available from their company, fabulous resources. They make you look really smart when you're talking to investors. So I would strongly encourage you to take a look at the tools that they've developed. Thank you for coming up.
Thanks so much, Matt.
Thank you very much for coming.
Gotta run. See you guys. Bye-bye.
David, thanks for hanging in and not heading to the beach.
Yeah, it was tempting. Yeah,
I can imagine.
My
Thank you
dog
for your
wanted
time,
to-
Dave.
Okay, bye-bye.
Yes, we will have the recording as well.